Welcome back and take a look at shares of Netflix, which are higher ahead of its earnings after the bell today, about 1%. So what are some key things to watch for? Tim Nollen is here with us. He's a senior media and tech analyst at Macquarie. Got an outperform on Netflix, and you just hiked your price target 20% about a week ago to $9.65. Why?
We think it's going to be a good quarter. And we think there are good drivers for Netflix in the intermediate and in the longer term. So I think for the quarter, keep in mind, this is going to be the last quarter that we're going to get subscriber numbers from Netflix.
Ever. They're never. I know they're moving away from it.
They may give us occasional numbers when they hit a threshold or something at some point, but we won't be getting subscriber numbers. This is the one number that has been driving the stock for over a decade now, and we won't be getting that number anymore, which creates an interesting setup where we're going to be looking at revenues. We're going to be looking at what's going behind the revenue. So in the quarter they're going to report, first of all, I think it's going to be a good, strong quarter because there's some big events. The NFL on Christmas had 31 million viewers, I believe, globally, which is an important point, which I hope we can get to a bit later. We're looking for a potential...
the big live fight, right? Was that also
the
Q4?
Jake Paul-Mike Tyson fight. I think that was well over 100 million viewers globally. Squid Game second season came out right around Christmas time. So a lot of big things that could drive subscribers and viewership.
So you already raised your price target, basically, which kind of gets how much of this might be priced in, right? When the narrative has been that good on it. And it's also kind of interesting you're going to look at revenue growth and not earnings or profits. In other words, it sounds like it's still growth is the most important thing for this stock.
Well, what I meant was without subscriber numbers to build into a revenue number, we're only going to be able to make up revenue numbers as forecasts. Maybe they'll give us some guidance, maybe they'll give us a regional breakdown, I don't know. But we'll just have revenue instead of all the buildup to revenue that we're accustomed to. But absolutely, operating profit is critical. And look at the other companies in the streaming space, Disney Plus, et cetera. All these companies are struggling to just get into break-even territory now. Netflix will be pushing 30% operating margins in a couple of years' time.
Wow. Which is what people who bought the stock at 100 times earnings 10 years ago always hoped, and here we are.
Right, so it's grown into that valuation, and it's still growing. And so the near-term story, obviously for tonight in an hour or so, is going to be, what the sub-numbers were, what the big events were, how that drove things. Then the question is, what are they going to be giving us in terms of guidance that's going to help us model this company going forward?
Right.
But you've got, I think, an interesting setup now with the advertising tier becoming an important driver for Netflix.
So I'm glad you mentioned that, and that's exactly what Laura Martin last hour talked about as well. Why is it so important, and what is so important when you're trying to figure out how much money the ad tier is making or how much money the paid tier is making?
Well, first of all, probably the advertising tier has driven subscribers up. To start with, they've talked about new subs coming on the advertising tier. So probably some of that growth is coming from advertising subscribers. It's a lower price point. It started off, interestingly, being accretive to the revenue versus the standard plan. They've since talked about that ARPU kind of coming down, or ARM as they call it, the revenue per member coming down. But since then, they made the decision to go with some of these ad tech outsourced suppliers. So some of these companies like the Trade Desk and Magnite, which can help them monetize their advertising much more effectively. It will take a little while, but we're looking for an upturn in advertising. So we're estimating $2 billion of revenue next year, $3 billion the year after that, $4.5 billion the year after that.
Wow.
It could just sort of take off from there. As the data and as the technology improves.
I'm going to say something I shouldn't, working for a media company, but we use Apple TV at home as well. We have cable, and we have Apple TV. And when I put something into my remote, we can use it by voice.
We can, too, now.
I don't even really know where the content is coming from anymore, nor do I care. I don't care if it's Netflix. I don't care if it's Hulu. I don't care if it's Peacock. It's the content. And I just was thinking about it literally yesterday. Is this going to damage these brands? Because if I don't really care where this is coming from, what's to keep me engaged?
Well, as long as you can access it. If you go to say, hey, watch the NFL game on Christmas Day, and sorry, you're not paying for Netflix, I guess that's how you find out.
To access it, yeah. I think the brand power at Netflix is still very strong. And to the point of the sports, actually.
Just because of NFL?
Oh, no, all kinds of reasons. I think people associate content with Netflix. Squid Game, I think everyone knows that's a Netflix show. So, Stranger Things, all these other shows, all these other Netflix shows. I think there is a brand affiliation with Netflix. But getting to the interesting point of sports, which we're a little bit early in this, it's not time quite yet. WWE is time now, that, if you call it a sport, that started just a couple weeks ago. That is 52 weeks per year of live event content. And I believe that drove something like 2.5 times the viewership on its first week in Netflix than it did last year on cable TV.
Really? Did it?
That's
Is that
the
what
number,
they're
the third-party number that I saw.
would love some color on that.
2.5 times. Yeah.
That's a big deal because it goes to one point about Netflix. Unlike a lot of the other platforms, a lot of people start their viewing on Netflix. You know, they're going there to figure out what they're going to watch.
Because there is so much that you can watch.
Exactly.
And now, down the road where it gets interesting, Netflix is finally moving into live sports. They've got the next 2 Women's World Cups in 27 and 31, I think it is. But what's really, really intriguing here is Major League Baseball can opt out of its contracts with traditional TV networks end after the 2028 season, as well as with the regional sports networks. So Major League Baseball, within a year or two, might be renegotiating contracts for the next batch. NFL has opt-outs in 2029 and 2030 on its network contracts.
The only thing, and I see where you're going with this, and it would make perfect sense, but these are going to be expensive. Do investors really want Netflix? I mean, and maybe they do.
Well, it depends. We estimate Netflix probably made money on the 2 NFL Christmas games just now. Yes, it's going to be expensive, but look at the global audience that they can appeal to. Now, these 2 Christmas games, I think, added 4 or 5 million viewers on top of 26 million in the U.S. That's a pretty good number. I actually thought it would be higher than that. And as the NFL is building its brand over time, you're going to get a lot more global viewership with Netflix. They've got a much, much bigger wallet. They've got $7 billion of free cash flow next year. They've got the money to pay for these things.
Tim, thank you. It'll be a fun afternoon to see what they say. Tim Nollen with Macquarie.